You know that feeling in the air right before a huge company like Costco reports its earnings? It's this incredible tension, right? It's a moment of truth that's packed with risk, but also, for those who are prepared, it's an immense opportunity. So that's the big question, isn't it? When a major report like this is on the horizon, how in the world does a professional trader get ready for the volatility that you know is coming? It's definitely not about guessing. It's all about having a rock-solid plan. And for any pro, it all starts with a map. Now, in the world of trading, that map is the price chart. So let's do this. Let's break down this specific game plan for Costco right before their big announcement. Okay, our first job is to decode this chart. And I want you to think of it like a detective story. We're on the hunt for clues hidden in plain sight, right there in the price action itself. And the very first clue that just jumps off the page is a classic pattern. It's known as a symmetrical triangle. But what does that actually mean for us? What's so powerful about this pattern is how it lets you see the energy building up. A symmetrical triangle is where the stock's price gets squeezed tighter and tighter between two trend lines that are closing in on each other. The best way to think about it, it's like a pressure cooker, just building up steam for a big, explosive move. And you can see it plain as day right here on the chart. Look at how the price is getting tighter, coiling right into the tip of that triangle just before earnings are due. You can almost feel the market holding its breath. Okay, so the triangle tells us a big move is probably coming, but it doesn't tell us where it might go. For that, we need our second clue, the Fibonacci map. Fibonacci levels, they create this incredible map of potential price targets and support zones, and it's all based on these key mathematical ratios. Just picture them like rungs on a ladder that the price might either climb up to or fall down from. So this gives the traders some really specific price zones to watch. The most critical one is this decision band between 988 and 995. A break above or below that area is a huge signal for the likely direction. If it breaks above, we've got upside targets at 1015 and 1047. But if it breaks below, the T support levels to watch are down at 981 and 973. All right, so we've got our pattern, we've got our price levels. The final piece of this puzzle comes from an indicator that actually measures the market's energy. It's called the MACD. MACD stands for Moving Average Convergence Divergence. It's basically a momentum gauge. And what's it telling us right now? Well, it's totally flat, completely neutral, and this just confirms our whole coiled spring theory. The stock is perfectly balanced, ready for a really powerful move, one way or the other. So, with all these clues gathered, we can finally move from just pure analysis to building a real, concrete plan. This is how a trader takes all that information and turns it into 3 potential, actionable outcomes. And let's be super clear here. This isn't about having a crystal ball to predict the future. It's about being prepared for the most likely scenarios based on all the evidence we just pulled from the chart. And here are those 3 scenarios, laid out nice and simple. First up, a bullish breakout. If the price closes above that 995 level, the targets become 1015 and even higher. Second, the bearish breakdown. A close below 981 could send the price tumbling down toward 960. And then there's a third option, a pure volatility play. This one just bets on a big move, over 5% in either direction. Each path has a clear trigger and a clear target. You see, this kind of thinking, it builds into something much bigger than just a single trade. It becomes a full-on trading campaign. And that's the key difference between just reacting to the news and strategically engaging with it. It's really like a general's battle plan, right? It's got phases. Phase 1 is the starter. You take a small position before earnings, but only if the price breaks out decisively. Phase 2 is the reinforcement. You add to that position after the report comes out, if the market confirms the move. And finally, phase 3, the objective. You manage the trade using data, and you take profits at those Fibonacci targets we identified earlier. Now, this all sounds great on paper, but how does it actually work when you've got a real live position on the line with real money involved? Let's adapt this analysis to a real-world example. And this is where it gets really practical, because the trader isn't starting from scratch. They are already in a position. It's a specific option strategy called an iron condor. Basically, it's designed to make money if a stock stays in a really tight price range. So let's check out the plan to navigate this position through the earnings chaos. So this current position, it wants quiet. It makes money if Costco's stock just stays in a very specific, calm range. But an earnings report, well, that's the exact opposite of quiet. It changes the entire game.
So, here's the 3-step playbook for adapting. Step 1. For this week, the goal is to let the short-term options expire worthless. Step 2. After that happens, the position gets much simpler, down to a single long call, which can then be adjusted. And finally, step 3, after the earnings announcement, execute a clear, pre-planned exit, whether the stock gaps up or gaps down.
And this all leads us back to the core philosophy behind this entire approach, and it's summed up perfectly right here. You're not just reacting, you're executing a pre-coded campaign. It's all about having your rules and your plan locked in before the chaos even begins.
So in the end, all this analysis, it provides a very detailed map of the possibilities. But the trader, they still have to navigate the terrain in real time. So looking at this map, with all its clear paths and its potential dangers, I've got one question for you. Which path would you choose?